Welcome to today's Explainer. We're diving straight into the multi-billion-dollar heavy equipment industry to completely demystify how it actually works. We see these massive machines on highways, construction sites, and open fields all the time, right? But the engine that truly drives this industry isn't just diesel, it's capital. Today, we're going to break down the physical and financial gears of this entire ecosystem.
If you've ever driven past a massive local farm and wondered how they afford a literal fleet of million-dollar combines, well, the secret isn't in the dirt, it's in the financial mechanics. It's this incredibly complex web of wholesale lending, depreciation curves, and strategic financing that actually keeps the world building and planting.
And the stakes have literally never been higher. These days, machinery is rapidly evolving from simple mechanical tools into highly advanced high-tech computers on wheels. So we really have to ask ourselves, how exactly do we pay for the future of farming and construction? Because as these machines get smarter, those price tags just keep growing, which completely shifts how operators approach ownership. To answer that, here is our roadmap for this explainer. First, iron meets tech. Second, a booming global market. Third, how dealers stock the lot. Fourth, the buy versus lease dilemma. And finally, the hidden used market.
Okay, Section 1, Iron meets Tech, the physical transformation. Let's start with the tangible product itself, because traditional heavy machinery is going through an absolutely massive transformation.
Take CNH Industrial's Iron Plus Tech strategy, for example. What's really interesting here is how major players are completely internalizing foundational technologies to build smarter, highly connected equipment. They aren't just bending metal anymore, they're integrating precision agriculture, automation, and AI directly onto the factory floor.
And you can see the real-world applications of this tech everywhere. Manufacturers are bringing some incredible capabilities right in-house. I mean, we're talking about Raven providing fully autonomous farming solutions, Augmenta using multispectral machine vision sensors for real-time agronomic data, and Beneman actually capturing fugitive methane from livestock waste and turning it into better-than-zero-carbon biomethane fuel. It's wild. It just goes to show that the modern farm runs just as much on data, vision, and sustainability as it does on diesel.
Moving on to Section 2, a booming global market, the macro view. Let's step back and look at how this technological revolution is driving massive global demand.
$277.13 billion. Just let that sink in for a second. That staggering figure is the projected value of the global agriculture equipment market by the year 2032.
That represents a super solid 6.14% compound annual growth rate starting from 2026. And look, this growth isn't happening by accident. It's totally fueled by the urgent need for mechanization, stronger global value chains, and the shift towards sustainable, autonomous operations. Farmers are dealing with crazy labor variables and environmental pressures, so they basically have to invest in this digital equipment just to keep productivity up. All right, Section 3, how dealers stock the lot, inventory financing. Because before anyone can actually buy this incredible new gear, local dealers need a way to physically put it on their lots.
You know you can't just order a fleet of $500,000 combines on a corporate credit card. So enter captive financial providers like CNH Capital. They operate as the financial backbone for the dealer network by offering wholesale inventory financing. This lets dealerships showcase a huge range of products without tying up all their cash flow. It gives them the capital to buy both new and used equipment from the manufacturer and have it ready the second a customer walks in.
So the whole game for dealers really comes down to the 180-day rule. The absolute ideal scenario is turning that inventory over quickly, within a 6-month window. If a dealer overstocks during a slow sales period, they're looking at some seriously dangerous cash flow challenges. It's a tricky balancing act that requires strategic planning with the lender so they don't overextend.
Next up, Section 4, the buy versus lease dilemma, creative financing. So the machine is sitting on the lot. Now the customer has to make a critical financial choice, buy it or lease it. It really boils down to technological agility versus equity. Since equipment tech is moving at lightning speed right now, leasing is a real game changer. It lets operators painlessly upgrade to the newest tech without trying to sell outdated machinery later. Plus, you get quicker tax write-offs, usually right in the year it's paid. Buying, on the other hand, is all about traditional long-term equity. But owned assets go into a slow depreciation pool, and you might actually hit capital gains issues when you finally sell it. It just depends on whether the operator wants equity or flexibility.
And that brings us to Section 5, the hidden used market, the high-stakes resale floor. This is honestly one of the most fascinating, unseen gears of the whole industry, because the used market has its own totally separate financial gravity. They are lending against what the machine fetches at auction on a bad day. That quote hits the nail on the head. When a lender looks at a used machine, they do not care if you got a good deal. They are fiercely protecting their downside. The entire logic here is a negotiation about the resale floor. If you default in 2 years, can they repossess it and auction it off for enough to cover the loan? That's what matters.
To really get why used equipment is so incredibly popular despite higher financing rates, you have to understand the depreciation cliff. Think about buying a car, but multiply the stakes by 10. A machine loses the biggest chunk of its value in its first few years. Buying used means you get the productive years of the machine at a massive discount, just because the original buyer already took the hit on that steep depreciation cliff. You're getting the flatter, cheaper part of the curve. And this is exactly how lenders calculate their risk based on age and hours. They draw hard lines that dictate your terms. Remember, lenders care about how old the machine will be when the loan is fully paid off, not just the day you buy it. So in 2026, interest rates on used iron range anywhere from 7 to 18%. The sweet spot, where you get the best terms, is a machine that's about 3 to 8 years old with moderate hours, especially from a brand with strong resale data like Caterpillar or Deere. But once you cross into that 11 to 15-year territory, lenders demand a much higher down payment, up to 25%, and cap the term at 36 to 48 months to offset the risk.
This underwriting difference explains why a traditional bank might just straight up say no to a deal, while a specialized private finance company says yes. Banks underwrite to strictly fixed policies. If you've got a 610 credit score and want a 12-year-old excavator, the bank system automatically rejects it. But private finance companies underwrite the whole deal. They look at your monthly business deposits, your down payment, and your industry experience. Plus, they can approve a deal in just a few days, which is absolutely crucial when you have a contract starting immediately.
There are also some awesome financing hacks out there. Leveraging specific government-backed or captive programs can get you terms that easily beat the open market. For instance, the Canada Small Business Financing Program covers used equipment up to $500,000. Farm Credit Canada offers super flexible tiered down payments. And definitely don't ignore manufacturer captive finance. Brands like Deere or Cat Financial often throw in highly subsidized rates on certified pre-owned units right there on the lot.
As we wrap up this explainer, I want to leave you with a thought about where this is all heading. As these machines evolve from heavy iron into autonomous platforms that require constant digital updates, the whole model of buying, leasing, and reselling is going to have to adapt. What happens to this multi-billion-dollar used market when the value of a machine is tied more to its software subscription than its actual engine? It's a massive shift, and it's definitely going to redefine the financial gears of this industry all over again. Thanks for learning with me today, and keep exploring the mechanics behind the world around you.